Good afternoon and welcome to today's webcast on the coronavirus and its implications on the global economy and financial markets. Today's panelists will be Roy Williams, John D'Angelo, and Paul Esposito, and this conference call will last up to a half hour. Just as a reminder, we cannot take any questions during the conference call, but if you send your emails to pwm@prestigewmg.com, we'll be sure to answer them. And with that, I will kick it over to Roy Williams.
Hello, everybody. We thought it was very important since the market volatility we had last week, significant market volatility, that we have a call and discuss really what's happening to the markets economy. But before I go there, let me just give you some current stats. So far, we have 106 cases of the coronavirus in the U.S. and 10,000 outside of the U.S. Outside of the U.S., in Europe, the cases seem to be expanding. Paul, we talked about it, the border, because you can easily cross borders there, it's spreading pretty quickly. And, Johns Hopkins came out today, and so far there's 3,117 out of 90,000 cases people have passed, unfortunately. And most of them were people with compromised immune systems or health problems. But to put it in relationship to the flu, so far this year in the U.S., not worldwide, 14,000 people have passed from the flu. So from a relative basis, it's... And of the cases, the 90,000 cases, I think it was 52 or 53,000 people have fully recovered at this point in time. And the other people are in, different stages of recovery. So, yes, this is a situation that, hopefully, and I know the pharmaceutical companies are working on solutions, but, it may take time. But with that, let's talk about one other important point. I was speaking to a friend of mine who's a doctor, and he says it's very important, if you're going to travel and you have health conditions, make sure you see your doctor before traveling internationally and even locally on a plane or on trains or any public system. Just see your doctor to make sure they feel safe for your situation to do so. So, Paul, why don't you start out by, discussing, some of the risks that we have in the financial market since the outbreak and a little bit of what happened last week?
Certainly, Roy. So I think if we assess the velocity of the correction that we had just within the last week and a half, obviously it unnerves a lot of investors. Really what that is the market's reaction to the unknown, right, of what this pandemic has. So markets, are usually going to tend to overreact in these types of scenarios because it's very difficult for us to quantify exactly how severe or less severe the impact globally to GDP, or whether it's to our own supply chains that will have on our own economy, which is the reason why we saw, the violent downturn. And subsequently, with yesterday's move in the market, it looked like some of the fears have abated because there's more information coming out on, survival rates, with regard to this affliction. At this juncture, it still is a little bit difficult for us to thoroughly assess what the implications are going to be, to a T, in terms of how global growth is going to be affected. At a very high level right now, I think it's fair to say that, if we look at where this emanated from, right, this is mainland China and periphery Asian countries. Obviously, Italy's been somewhat affected by it as well. But given the fact that China is responsible for about 30% of global GDP, the disruption to their economy, which has persisted for at least about 2 months now, and is expected to persist probably for the remainder of this quarter, could translate into about, a 0.5% charge to GDP, global GDP growth.
Which still would leave us, Paul, in a positive GDP for the quarter.
It would. Now, there is the potential, again, anytime we get an exogenous shock like this, first of all, it's difficult to ever, truly prepare for something like this. This is truly a tail risk event. But, if we were to actually look at the implications, coming, to our earnings, the vast majority of a lot of our supply chain is dependent upon China. So, in looking at some of the numbers there, we do anticipate that this will probably cause flat to negative earnings for at least a quarter, possibly 2 quarters, which is why, markets have discounted that very, that event.
Also note that the Fed came out today, cut rates by 0.5 point on a surprise move to try to support global GDP.
Right. So I think that's also very important. When we talk about the uncertainties of the market, given an exogenous shock like a pandemic of this sort, it's very important for us to put that into context of the environment that we're in. Not only our central bank, but other global central banks are very accommodative. The Bank of China has, pledged that they will do whatever it takes to stave off liquidity crises and so forth. We've had a number of other central banks throughout the globe accommodate to, again, help quell the concerns of the unknowns of the impact of this virus, which, again, is very important. We always try to borrow from past experiences and use them as proxy for the future. A lot of individuals say that this exogenous shock is, similar to, an 08-09 scenario, and I'm going to starkly disagree with that for the express purpose that we are in a very, very loose monetary environment, very accommodative. If we were, experiencing an exogenous shock and we had very tight financial conditions, we didn't have a low unemployment rate, we didn't have central banks easing, then I think things would be very different. But that isn't the case. We are seeing that level of accommodation come through. The Fed does have more policy tools at hand, and we really need to see how the rest of this plays out to truly assess, if in fact the worst fears of those supply chain implications and impediment to global growth actually manifest. If they don't, if a lot of what's been pandered by the media, which, I must say, John, we talk about this all the time. Anytime we get negative news in the financial markets, there's a lot of, should I say, a lack of balance. What was focused on during the onset of this crisis, it was, 3,100 deaths. We've had 91,000 global cases. But what a lot of media pundits fail to recognize is you've had an over 50% recovery rate, which, again, we're not trying to dismiss this as, a non-issue. When we put this into perspective with, regard to, other ailments, namely the flu, again, this, is not as severe.
So I think the point that you bring up that's important to note, though, is that for clients, that the media tends to sensationalize these type of events, whether they're positive or whether they're negative, because that's how media companies make money.
And if we look in the past, the pneumonia plague from '94, the market was up after, 6 months. The swine flu, the market was up, in most cases double-digit. Zika, Ebola,
SARS.
And, SARS, the avian flu, most of those cases, 6 months later, the market was positive, and in most cases double digits. But it doesn't mean it's going to happen this time, but that just shows you, as John, as you're saying, when they sensationalize the situation, it gives a downside, but the bounce back could be just as quick.
Right, and historically, you're right. These type of events tend to be temporary and short-lived.
Yeah. So, John, why don't you talk about the importance of asset allocation?
Yeah, right, Roy. I mean, when you have what I would call an unanticipated event, it could be a geopolitical event, or it could be just like we have now with Corona. It's critically important. The only free lunch that you have is to be diversified and well allocated. And it's really important that the way that we structure portfolios for clients, they're structured to be able to weather these type of situations. So, when you think about it, you can't predict. There's not a predictive mechanism in place for you to go, oh, well, we're going to have this quick systemic shock that's unanticipated. That is why it's critically important that you're not in an unbalanced portfolio, or that you're not in a portfolio that's either too risky or too conservative, for that matter, for your goals and objectives. So, I know a lot of times when we have these type of things, people get panicked, they get nervous. There's no reason to be panicked. There's no reason to be nervous. Let the asset allocation and the diversification work. Over the long haul, your portfolio will weather this event just like it would weather any other, any other short-term shock that you would get to a market.
Yep. And speaking of that, when we withdraw money, Paul, from a portfolio, when we have this kind of shock, where do you, as being our senior portfolio manager, where do we normally take the money from?
Well, we're normally going to take it from assets that are less beaten up, and in this situation, all withdrawals in the last few weeks have come exclusively from bonds. Because
and that's important for clients to understand, because most 401ks, when you take withdrawals, they will sell stocks, they will sell U.S. International, sell across the board, where we tactically will look at where to take the money from in the portfolios.
Right. And I think, Roy, it's important, to highlight, just to let all of our clients know, from a strategic asset allocation point of view, from the start of the year, given how late cycle we've been in, this current economic expansion, we've had the portfolios positioned to be more defensive. That's been a theme that we've carried out, since the middle of last year, was having predominantly almost all large cap U.S. exposure in the U.S. portfolio, being underweight in international markets, not having as much exposure to those sensitive asset classes like small and mid cap stocks, and keeping our fixed income to the utmost high quality, not buying junk debt, which behaves very, very, very similar to stocks in an equity route like we experienced last week. So we're very mindful of that, and just as an addition, we also have a minimum volatility component in the stock portfolio to help minimize these downturns. So we're cognizant that we are going to, we're in a higher volatility environment. With the lack of volatility that we had last year and the robust returns that we had in the equity market, we were prepared for a bout of volatility. I will admit, not to the extent of a 6-day rout that we saw, but we are aware that we're in this environment and we're prepared accordingly to act.
Yeah, Paul, to that point, last week I was at the Forbes conference where you have some of the top economists and strategists from every company from all over the world, and really nobody was predicting this kind of shock, there. So it does happen in markets and has happened in history, and the best thing, as John said, is to have, the portfolio positioned properly. Let's talk about rebalancing, Paul and John, a little bit, in terms
Sure.
of, a lot of people will say, well, when do you rebalance?
Yeah, I think the most important thing is that we take a cautious approach, a very thoughtful approach, to rebalancing. There certainly can be some opportunities for us to add to the equity markets if the conditions present themselves where it makes sense. And I think that we'd have to see some type of conviction within the marketplace that we're getting a little bit of positive momentum, a little bit of positive news. Certainly it could come from a confluence of different events. Maybe there's a vaccination that gets approved to, news that the outbreak is controlled. And when we start to see what I would think to be more of a green light for the economy and for asset prices, then I think there may be some opportunities for us to take advantage of that.
Yeah, and once we see direction, Paul, we were talking earlier as an investment committee, we can and will make changes as we have in the past to the portfolios.
Absolutely, Roy. And I think patience is certainly going to be one of our most useful tools here, because we don't and never will be reactive to sudden jolts in the market. I mean, we'll never take a stance on trying to time things, as evidenced by just what we experienced over the last few trading days. Down over 10% in a 6-day route, and then of course we get almost a 5% recovery. We want to take a look at the run of fundamental data, which could take a little bit longer than a day or two to permeate. I think it'll be very interesting for us to see where earnings lie for Q1 and what the the guidance is for Q2. That will give us I guess just a little bit more backdrop for effectuating a rebalancing effect. But we are vigilant. We are looking at opportunities. They're starting to manifest rather nicely, not only in the equity market but also in the fixed income market. There's some decent opportunities. But to John's point again, we want to be patient. We want to make sure that cool heads prevail, and the last thing that any investor should do is make a rash decision based upon a very small run of data and a lot of unknowns, a tremendous amount of unknowns. It'd be very interesting to see how this all plays out within the months ahead. We very well may be looking back at this time and kind of questioning some of the some of the moves that occurred in the market as being rational or not. But only time will tell that tale. For the time being, we'll just have to see how the information comes out.
Yeah, some action I think people could take is if you yourselves or your children have mortgage debt, now may be the opportune time to look at refinancing that debt to lower rates and locking in lower rates, because there is an opportunity for that right here and now.
Yeah, it's an excellent point. We haven't seen mortgage rates fall to these levels probably since 2011.
Yeah, so take advantage of the opportunity. Those who financed at 4.5% to 5% a couple of years ago may have that opportunity to lower their debt payment. In some cases, pretty significantly, or shorten the duration of their mortgage from 30 to 20 or 15. I want to thank. Any other points that you want to make, Paul and John?
I think I would close just by saying that the most important thing for our investors is to remain calm and not to be emotional. That there will be potentially positive, negative information that could come out in the next few weeks regarding the virus and the impacts. And at the end of the day, in 20 years from now, 15 years from now, it is not going to have a significant impact or an impact of any type of significance on clients' long-term returns. And I think that's the most important thing to remember.
All right. We want to thank everybody for the time, and we'll keep you informed as things move forward. We'll probably have additional communications in the next few weeks as things evolve, because I think this is an evolving situation. We want to make sure we stay on top of it and communicate everything to our clients as things move forward. So we appreciate the opportunity to discuss this with you today, and we want to thank you for your time.